Hello everyone, thanks for checking out my video. Earnings season is ramping up as giant companies such as Tesla, Netflix, Goldman Sachs, Johnson & Johnson reported their earnings last week, and their results came in mixed, or if anything, it was a little disappointing. This week, a flood of earnings awaits us, with Microsoft, Amazon, Google and Meta report their results. It will be a huge test for the tech stocks. Anyway, despite the subpar company's earnings, stock market continues to move sideways. So why are the bears not able to keep the market down despite the poor earnings? Is this a sign of the start of a new bull run? Let's dissect some of these questions in this video. So, as shared earlier, the stock market continued its sideways movement last week, with the major indices falling a little bit as investors evaluated the latest earnings results, concerns of disappointing profits and cautious forecasts of the economy. When we dive in deeper into the various earnings reports, we would realize that we are getting a little of mixed indications from the different companies, even those within the same industry. This then means investors remain confused as they try to determine the next direction that the market is moving. I mean, at any given moment, earnings results and forecasts reflect almost everything that's happening in the US and perhaps even the world, from the economy and the Federal Reserve to interest rates and geopolitics. But unfortunately, the earnings results that we have gotten over the last week has not been conclusive. With the Federal Reserve in its quiet period, the market will continue to focus on earnings this coming week, with many mega-cap tech companies set to report their quarterly results, with Amazon, Alphabet, Meta and Microsoft leading the way. Both bulls and the bears will hope that these companies' results can help to move the market more significantly instead of going just sideways only. And on paper, it should actually. By themselves, these few mega-cap companies have a big impact on the major indices. Their forecasts and comments on the future growth in key areas such as AI, cloud computing, e-commerce, etc. will have major influence on the tech industry and beyond. It could well give us a sneak preview of the kind of economy we can expect from now till the end of the year. Alright, now let us move on to the technical analysis section. You know, sometimes I find technical analysis, or in short TA, quite amazing. Check out this chart. Look at how SPY is respecting this green dotted uptrend line. It's like floating right below it and moving along with it for the last 10 over plus trading days or so. However, over the last 2 days, it is showing a small sign of weakness as it created lower highs in the last 4 trading days. As you can see, SPY has been on this uptrend since mid-March this year. So now let me share with you on how to spot the trend reversal, if it happens. First, look out if there will be further lower highs in the next few days. Next, watch if the MACD will have a bearish cross this week. And then watch out for the 3 key levels at the bottom. The first level is the small little gap at 404. The second level is where the 50 moving average converge with the next gap at 401. Finally, keep an eye on the critical 400 level. So, if SPY starts going below these levels, MACD has a bearish cross and we start to have lower highs, that is what we call a confirmation of a reversal in trend, from bullish to bearish, at least in the short term. And that will also give us high probability of filling that bigger gap between 396 and 398. The panic for bulls and the stock market will likely set in if we break the 200 moving average at 392. On the other hand, if earnings and forecasts from mega-cap tech firms come in better than expected and the market wants to rally, then bulls will want to bring SPY above the recent high of 416 and the green dotted trend line. If we go above these 2 levels and hold it there for about 2 or 3 days, that will then be your confirmation that the bulls are gaining back momentum and we are continuing this uptrend. This will then give us higher chance of filling that tiny gap between 419 to 420. Lastly, if we break above August high of 426, and if you continue to be bearish about the stock market, all I can say is sometimes we shouldn't be too stubborn. Trade or invest what the chart is showing you, rather than what you think. Moving over to Apple. Apple seems to have some difficulty breaking above this 166-167 area as sellers keep stepping in. This then makes this area a battleground for bulls and the bears, which means if we break above this, Apple can easily fly to 170's range. That will then bring us above the downtrend line and also fill the gap at around 170. Once again, just like SPY, if we break above August 2022's high of around 175.5, bears should admit defeat, unless we have some black swan event or huge surprise that could tank the market again. Interestingly, both RSI and MACD are pretty flat at the moment, which means both bulls and bears are not in control at the current level. So it seems like we may just chop around the current range until its earnings day, which will happen on 4th of May. Anyway, let's say if sellers start to overwhelm buyers at this 165 area, on the downside, watch out for the gap at 158 to 159, which will then act like a magnet to pull Apple towards that level. A strong support should come in at 156, because that is where the 50 moving average and the 23.6 Fibonacci retracement level converge. Honestly, even if we touch this level, there is nothing for bulls to worry about just yet. We can only say Apple is weak or in a bearish trend if we start hitting the 200 moving average and the 38.2 Fibonacci level at around 150. This area is also where the Ichimoku cloud is. That's like 3 support levels coming together. Therefore, if this level gets breached, then bears could open the floodgate, and we are talking about the gap at 146 to 147, as well as the 50% Fibonacci level at 145. Alright, moving over to Tesla. Guys, I have shared on Tesla's weaknesses about 2 or 3 weeks ago on 6 April on Moomoo, when the stock was at 180s range. I guess it has proven that it was a spot on call as Tesla dropped to 160s last week. And just last week, I have shared in my video that we can expect a huge movement post-earnings. It's either we get to 200 or we hit 160s range. Well, I have to admit that I was not able to predict or was not certain whether the huge move will be up or down, but it was still a correct call as I have given viewers the early heads up that the stock will stop chopping around 180s range and have correctly called for a minimum 20 points movement. And if you combine this with the earlier weaknesses that I have shared, if you are a bull, you would have adopted a defensive mindset. Anyway, the reason why I am sharing all this is not to brag about my right calls, because just like any other person, I made wrong calls too. The message here is I am providing all this content for free, and I really hope to get more of your support to keep this channel going. And this brings me to the support challenge. Once again, we missed last week's support challenge, and if I may, I would like to call for your support again this week. Let's help out this channel by showing your support via either of the following options. The very first option is the easiest, and that is to tap the like button. The aim is to achieve more than 45 likes because that is the maximum number of likes I have received from my videos. In case you don't know, the number of likes and subscribers will help to push this channel and the videos to more audience, and that will help to keep me going. The second way to show support is via the coffee link in the description box and comment section below. If my content has been helpful for you, you may consider buying me a coffee. But of course, this involves money, so please no obligation, right? The last way to show your support for free would be to sign up for a Webull account if you have not done so. It basically works like Moomoo and Tiger. The current promotion is that you just have to deposit say $1 and both you and I will get free shares. I think the promotion is ending on 28 April, unless of course they decide to extend it again. Alright, let's go back to Tesla. Let's say Tesla's weakness continues this week, we could easily break the support at 159. The big gap at the bottom, which is between 146 to 154, will be the best target if they want to bring Tesla down. So again, don't be surprised if we hit this level, a level that I have been talking about since many videos ago. At this area, the level 146 should offer some significant support, and that is also where the 61.8 Fibonacci level sits. Bulls have to protect this area, because if this area gets breached, can you see these 3 gaps at the bottom? They are in the 130s, 120s and 110s range. But let's take one step at a time. Let's see if 159 and 146 hold or not. On the other hand, if Tesla wants to rebound, the first target for the bulls would be the gap down we had last week, which is between 169 to 177. If Tesla fills this gap, it needs to hold above 174 support level. The uptrend will resume if we break above the resistance level at 190. In fact, this is one level I have been watching for the last few weeks as Tesla chop around the 180s range. That level is a small signal for me that Tesla trend is bullish if it goes above and stay above it. By doing so, it also means Tesla has successfully reclaimed the 50 moving average. For stronger bullish momentum, Tesla has to go above the 200 moving average at 212 and break above the recent high of 217. Moving over to Google, I actually closed one option contract and opened a new one last week. More on that in the options trade segment. In terms of technical analysis, it seems like Google has not been able to break above this 108 and 109 range, as it gets rejected on 4 occasions since February this year. So, if you are looking for a bullish trend for Google, it's relatively simple. Basically, Google has to break free from this 108 and 109 area, and even better, go above 110. That will then fill that 109 gap and potentially unlocks more upside towards 120. For info, 120 is the top end of this consolidation zone that I have previously shared. Okay, in terms of the bear thesis, remember last week I shared that there is a bearish divergence on the RSI and the MACD is about to have a bearish cross. I then urged viewers to keep an eye on the MACD, and guess what? MACD had its bearish cross and Google fell to as low as 103 last week. But to clarify things here, bears are not in control yet. 2 areas to watch for bearish confirmation. First, we have to break below 105. Then we need to close below 100 for a few days. The latter is more important for bears because below 100, it means we are also below the 200 moving average. I would only say Google is in a bearish trend if we break below the 38.2 Fibonacci level and the 50 moving average. In other words, below 98. Okay, moving on to the options trade segment. There is quite a fair bit of things to share this week, so let's dive straight in. Last week, I had 3 option contracts expire. The very first one is Bank of America. This particular put contract was sold about 1 month-ish ago, where the whole world was talking about the US banking crisis and several major US banks saw their shares dropping massively. Amid the massive sell-off, when fear was high in the banking industry, I took the opportunity to sell a put contract for Bank of America, which is a slight bullish move. Basically, I was just following the famous quote of be greedy when others are fearful. Furthermore, I saw that the IV for Bank of America went up to more than 60%, and that is super rare. For context, its average IV or implied volatility has always been around 30%. Therefore, 60% was like 2 times the usual. And in case you're not aware, higher IV usually means higher premium for put sellers like me. Anyway, the contract expired worthless and I didn't have to do anything to keep the premium that I received. Next, the other put contract that I sold that expired worthless is Tesla, with a strike price of 140. If I don't recall wrongly, I think back then in March, when I sold this contract, I saw that Tesla was showing some strength and it was unlikely that it will fall to 140. Therefore, I sold the put contract. Furthermore, based on technical analysis, I also saw that there is a strong support at 146, and I was of the view that 140 was a good strike price below the support level. Finally, the third contract that expired on Friday was this one with Google. Unlike the other 2 put contracts, this is a covered call contract. It did not expire worthless as Google was floating around 105, and I closed the contract on Friday for a 96% profit. Basically, back in March, I received $285 as premium when I sold this covered call, and last Friday, I paid $11 to buy back the contract to close the position, and that gives me $274, aka 96% profit. Just to share, I wasn't too eager to close the contract early last week because I saw that Google got rejected at 108 to 109 level, and MACD had a bearish cross. Remember we covered all this in the TA segment, and true enough, Google continued to slide to 105, which gave me a better opportunity to close the contract with good profit. And here you go, this is how you can use technical analysis to trade options. So do subscribe to my channel if you have not. Anyway, on the very same day when I closed my Google covered call, I sold another one with the strike price of 110, expiring 26 May. Sorry that I am not showing the premium yet, just in case viewers blindly follow my trade, and that isn't my intention at all. Alright, so the reason for me to pick this strike price is that as mentioned, 108 and 109 has proven to be a strong resistance for now, and I think Google will have difficulty breaking above it, especially my view is that Google's upcoming results may not be very ideal. That being said, market can be irrational, or I could be wrong about Google's result, so Google can still rally and go above 110. Am I worried? Not really. Why so? The reason is simple. If Google goes above 110, my contract will only expire end of May, so this means there is still time for Google to come back down. And even if Google doesn't come back down or rally to 120 and my contract gets assigned, I will be forced to sell 100 Google shares at 110 strike price. I am okay with it too. If you recall, my base price for this 100 shares is $100. So that means I will lock in 1,000 profit on top of the premium that I have received when I first sold this covered call. Okay, that's all for the update on my option trades. Hope they have been informative. Do tap the like button if it is useful. Some end thoughts to wrap up this video. Again, like last week, my view is that the stock market is in a confused state. Well, on one end, you have investors expecting the Federal Reserve to cut interest rates later this year. But then, on the other hand, the Fed officials have been telling us that they are going to hold the interest rate high up there for quite a while. Then, you have economists predicting a recession, but yet unemployment rate has been staying at near record lows. As a result of all this 50-50 calls, the market is like not falling apart and not really rallying much either. Technical wise, the major indices are stuck in the range between their early 2023 highs and their 50 moving average. In my view, at some point, the market will break out of its recent range, but for better or worse, we really don't know. In case you go, that's like not saying anything. Okay, my personal view, not financial advice of course, is that I think we can expect some huge movements in the next 2 or 3 weeks because of 3 catalysts. Firstly, we all know the various mega cap companies will report their earnings this and next week. Then, we have the Federal Reserve coming together to discuss on the next rate hike in early May. And finally, the next CPI number will be out on 10 May. So yeah, buckle up as we will be in for a wild ride in the upcoming 2 to 3 weeks. Overall, the stock market has not been special or exciting for the last few weeks. It's all sideways action, short-lived rallies, and some rotation of money from one industry to another sector. But here's the thing, when the stock market starts to making a strong move, it can come really fast and can catch investors off guard. Therefore, as a long-term investor, my view is that if the market decides to rally big time in the coming weeks, one could easily miss out on good entry prices. So to prevent that from happening again, my view is that adding exposure gradually at this point could be something that long-term investors can consider. Note, it's adding gradually, meaning to add bit by bit. By doing so, even if the market decides to tank instead of rally, you won't be sitting on huge paper loss and can continue to add more shares at a cheaper price. Basically, this strategy of DCA or adding shares slowly is more to prevent one from missing a potential new bull trend. Finally, my view of the market remains bearishly bullish because while some signs of cracks have emerged here and there, earnings season has so far conveyed a picture that most have anticipated. This is also why the bears are unable to push the market down. Okay, that's all for this video. Which company's earnings are you more interested in? Let me know in the comment section below. Please also help to boost the growth of this channel by tapping on the like and subscribe buttons before you exit this video. I will see you in the next one. Thank you.